Good afternoon. My name is Fred Amrein, and welcome to College Affordability. Paying for College is today's webinar. We're doing an afternoon lunch webinar, so this is something different and new, and hopefully people have made it a little bit better for them fitting into their schedule. Just quick things, some notes here. On the right-hand side, you should have a text box where you can send notes. We will be happy to answer those questions at the end of the presentation. Should take about a half hour to 40 minutes to go through the information, and hopefully you find it helpful to go through this. Just a quick view of who I am. My name is Fred Amrein. I'm a fee-only financial planner. What's unique about myself is that we cover from the entire saving for college, financial aid positioning, all the way to student loan forgiveness, and repayment. I'm the author of a book called Financial Aid and Beyond, Secrets to College Affordability. And I'm a nationally recognized speaker, spoken at different CPA organizations, financial planners organizations, college planners type of events, State of Pennsylvania's 529 plan, the National 529 Conference. So just a view of who I have spoken to. And also the developer of the EFC Plus tool, which is now available. And we're going to see some of the screens. We're not going to go through the details, but it is really a helpful tool if you're in the college decision process. It's going to put all your information in one place and allow you to make a better college decision. Just as a footnote here also, Amrein Financial is an independent fee-only financial planning firm. We are registered investment advisors. We will discuss some financial products today. That is not a recommendation. It is purely information. You need to consult your financial professional or tax expert before making any investment decisions, and past performance is no guarantee of future performance. I think the biggest thing that we try to do as we go through this process is help the clients and people focus on the outcome. There's so much marketing. The schools do a very good job of promoting the schools. You need to really take a step back and try to understand what the outcome is. And again, there's such a pressure on the information. We just wrote an article, I think it was just posted about the transfers. Transfers are about 35%, so we're wrong about 35% of the times. I can say my first two, we changed schools and changed majors for both of them for very different reasons. But you think you know what you're doing, and it can be a very emotional time. The largest reason why students transfer also is financial. So when you look at graduation rates nationally under 40% and transfer rates at 35%, it just kind of looks at what are we doing here, and are we doing as good a job as we should? So today's agenda, what we're going to do is understand your financial aid position. We're going to look at how the financial aid office actually look at it, or the colleges look at you. So it's very different. It's called enrollment management. We're going to go through that. And another big thing that's changed, what we're trying to bring to the public is the importance of cash flow. And this gets into understanding how you're going to structure your debt, what debt will look like. We're seeing college debt, exceeding 1.3 trillion. Over 43 million people have it now. It's becoming a problem. A lot of it has to do with understanding the cash flow. So we understand what we will pay via the award letter, but actually how we're going to do it, and that's what the EFC Plus tool does. I think is an important part. Comparing value, again, having a broader view, looking at the financial outcome, when you're going to spend your money, when your child's going to need to go to grad school or whatever, I think is an important part. And this way, hopefully, will allow you to make a better college decision, both from a fit standpoint and financial standpoint. So a few major changes. We just got back from the financial aid conference. It's held annually. It's a great conference. Got back from that beginning part of December. Here's a few things that have changed. So the college list change, which is really great for the students and the families. In the past, the colleges could see your entire college list, and some of the schools would use that to on their admissions process, or even in their financial aid packaging based on where they were on the list. Going forward, starting this year, the schools will only see their information or their list. They will not see where they are or what other schools they're competing against. The new thing also is that they have to, or you need to have your FSA ID. That will replace the 4-digit PIN. There is an issue there that's not my slides here that I found out at the conference, which is a little alarming. If you have set this up, you probably can't go back and change it, but you need to, for your parents' privacy, the way it's set up is it's basically one email per ID. So the schools, once their child gets into college, the schools expect the child to have full control or handle everything. When you fill out the FAFSA form, your child will have access to all of your financial information. So they'll have your social security number, they'll have your birth date, they'll have how much money each of you make, how much assets you have based on the reporting requirements under the FAFSA form. I have a privacy issue with that. You as a parent don't have access to their grades, yet the child has access to all of your financial information. The school requests your information, they print the report out, and by chance, it's sitting on their desk and you don't know who's in their room. So you just need to be really careful. It is a legal document, so you have to be really careful here in the sense that having your FSID to maintain your privacy, it would be great if you, as the parent, would establish the FSID with the student with your email address. That way you can give them the password when they need it. Say they will need it to sign their promissory note. And if they need to go in there for like the college requesting information, it would be important. But you just sign it for them is legally incorrect because that would mean you need a power of attorney to do that. So you need to be careful, but you also need to practice your own privacy. There's the new timing process called prior. We're going to talk about that in a few minutes. And there's a few calculation changes. The biggest impact affected married couples. The allowance or asset allowance allowed by the parents went down significantly. Hopefully that's based off Social Security process. So there's not many changes there. And then there's the new college ranking system called College Scorecard. Saw it, not really impressed with it. It is another set of information you can look at. It was supposed to be more of a guideline for where money was going to be deployed by the Department of Education, but the Department of Ed and the government has pulled back from that, I guess, importance. As you go through this process, I think there's three major things you need to look at to make your best decision. So understanding the academics, the majors that are offered at each schools, the likelihood your child's going to stay in that major, it's important. I always recommend that you visit the career centers for a variety of reasons. One, if your child's not sure what they want to be, that you find out what tools and processes do they have to help your child make that. They have to make that, in my eyes, by the end of their freshman year, because if they don't, the likelihood of them graduating on time is not as good. If they do know what they're going to do, it's an important part to find out what internship programs, what co-op programs they have, what placement they have under that career, all, again, focusing on the outcome. Next is campus environment, big school, small school, how far away from home. All those things are important. And then what we specialize is in the financial aid process on how are we going to pay for this? What do you look like at graduation? Why do we structure the debt certain ways? All those things have to come together to make your best decision. And again, you have to have an open discussion with your child as you go through this process. So what do you need to do to create the proper plan? One, I think you need to look at it a 4-year plus, especially if they're going to go to grad school or need that to get their education. As I said, a lot of times I'll use my family as an example. My oldest needs a master's. She's a speech pathologist. So we knew that when she decided on that degree. And that was the end of her freshman year, actually mid-year through her freshman year. Yet my second one's a math teacher. And it was better off for her not to have her master's because a lot of jobs she was going for were union jobs, and that would determine her availability and what the schools wanted to pay. So again, that's an important part, knowing that the sooner you go, the better. What are the education requirements? Again, I'm going to use my children as another example. My youngest is an accountant. The accounting rules changed when she was in school, that you needed 150 credits to sit for the CPA exam. So knowing what the education requirements are to get to the jobs they want, what do they look like at age 25? What debt will they have? What will that payment be? How will the debt be structured? Who's legally going to be responsible? All critical things is how you go through this process. Colleges will only give you information 1 year at a time, so that is a flaw in the process. Our process, the EFC Plus process, kind of addresses that. We do the 4-year financial outcomes. And the financial aid directors are kind of limited to what they can tell you, so they're really restricted on only the financial aid process. So if you wanted to take an alternative loan, say maybe a home equity or a loan out of your 401k, they can't address those issues. So that is a shortcoming of the things, or what 529 you should be in and why. And just be really careful of the scams that are out there. It is an opportunity for a lot of people to take advantage of people. Typically as a thing, and this isn't a scam, but there's some financial professionals that will look at annuities and life insurance out there. You need, if it's just purely for college, it's probably not appropriate. Again, you need to know your numbers, but if that's the solution that they're recommending, it needs to go beyond college. It needs to be much broader. It needs to be looking at your entire retirement and those type of things as part of your process. I think a big issue here also is the focus on the EFC number. Everyone focuses on trying to lower that number to maximize their financial aid position. We're going to talk some in one of the future slides about that may not be the best things, but a lot of times we overlook a lot of different opportunities within the process. So understand your EFC and how that's put together. Everyone think it's one number. We're going to tell you it's really not. It's 4 separate numbers. Understanding the tax credits and how to manage your adjusted gross income to maximize your tax credit. There's an American Opportunity Credit that's worth $2,500 for you. The college selection. So this is important if you have multiple children, and if multiple children are going to school at the same time, one school versus the other has maybe a better gifting policy where you're going to qualify for aid maybe in those second or third years when you have 2 in school or something like that. That's an important part. And then the outcome, what's the graduation rate, what's the retention rate, how you structure the debt, who's legally responsible for that. The students typically have better loan repayment and loan forgiveness options than the parents, and then how much do you want to legally be responsible for? It's an important part as you go through this process. So what is my positioning? We have a tendency to look at just the academics. Everyone's familiar with, an academic reach, but we really don't understand, and we will, show you how this works. But schools actually look at financial reach at the same time. And we don't look that, they market to you as a parent as you sit in those admission office meetings. Oh, you need to apply, we have plenty of financial aid. That really helps them for their ranking systems. All the rating systems are looking at selectivity. So if they have more people applying and less people accept it, that moves them up on that, competitive scale for those ranking systems. What you need to do as a parent and is take a step back, or a college or a financial planner, is look and see what that's going to work. And we're going to show you how it works behind the scenes. Schools saying they're need blind. Again, I don't believe that is true. What a lot of people don't realize is, the schools, if you went to the college scorecard, most of the Ivy schools are in that, high teen numbers in the 15, 17, 18. And you're saying, well, we can go to those elite schools at that amount of money. What we don't realize, or it's not told to you, is that 65% of the student body are full pay. So they're only talking about 35% of the students, or 30% of the students who are going to get into that school are going to get financial aid, and that's why that number can be distorted. So again, just be aware of this, and you end up spending a lot of money on the applications, and you need to be aware of that. If anything you get out of this presentation today, college is a business, and they're going to select your child on their ability to pay, on what they need in the class, and that will change year to year. So some people, we think that these, we make these global or general statements, but the schools are evolving. So an example would be maybe the school had a high attrition rate from their business school in the prior year, and they need to have a much more larger class in business. So they may give more money if people are applying to the business school this 1 year, and next year that money goes away. So now you're comparing to last year's class that Johnny got, $15,000 of a scholarship, and my child's smarter and better, and yet your child's applying to sciences, and you're not going to get the same money. So just be aware of that. It is a business, and they will change their strategies just like any other business that we see year to year. It is a lot more complex, and you're going to see how complex it is in a second here. But schools are really looking at on an average net price, or an average net revenue per student. So if you now lower your EFC and become more available, or will qualify for more aid, that also will probably reduce the opportunity of your child getting in, unless they have some special skill that's unique and the school really wants it, an athlete, a performer, or something like that. But just remember, as you lower your number, the business aspect will kick in, and there's less and less spots for your child to get into the schools as we go through this process. A lot of times when we're working with divorced parents and their incomes are very diverse, we actually ask them, what's more important, is that you qualify for the aid and maximize that potential, or do you want to have a better opportunity of getting into the schools and choosing from that selection once you get in? So it is an important part. This is the enrollment management matrix. This is what I was talking to, and this is what the schools actually do. And you need to take this. A lot of people don't understand how this works. It is relatively new concept, at least to the public, but the schools have been doing this for years. So the horizontal line is the average SAT GPA. This is in our matrix it's all unweighted numbers, and there's a lot of subjectivity here on that. Admission strength could include their interview, they have a unique skill set, their letters of reference, all those type of things are unique. First generation, what state you come from, can all factor into that admission strength in that vertical side, the y-axis. And the horizontal line is the average SAT GPA. What's not told to you, so we know what academic reach is there. In this case, the blue dot, this student's above the academic reach, so they have a very good chance of going there. What's not explained to you is the vertical line here, which is the average package for that school. So in this case, the school's average package is $16,000, but this child needs $19,000 to go here. So you can see they have a slight reach. It's not significant, but if we were to go out and say this child needed $32,000 of aid and was in the same position, just over the average, what we saw in the last year, when the first year we had this concept, is if the child was average, the school would typically come close to the average package. And what happens there is now you've wasted the time and money to apply to the school. If the child does get in, that's great, but the likelihood of them it being affordable for them becomes very unlikely. So now you've wasted the money and time to do this. We're just trying to help people better educate the situation. Now, again, this is only a one-year view. If you have multiple children coming in, and that's the other advantage of our EFC tool, is we're doing 4 years. If, say, you have a second child coming in, your EFC number, you may qualify for more, and now in those outer years, it may become more attractive for you. So again, this is really important. This is where the business, actually, each one of those boxes represent the revenue stream for the student or for the school. And what you don't realize is that some of the schools break up their student body on the admission side into as many as 300 boxes. So it can be very sophisticated, and you don't realize that because you're hearing when you're sitting in the admissions office, oh, you need to apply when we put in financial aid. Just going to quick review of where you're going to get your financial information from. The guidance counselors at the high school often overworked. Their focus is on admissions and transcripts and all that stuff. They really don't have the expertise on the financial aid area. College admissions office is, if we look at this as a business, they are the salespeople. You need to realize that they are the salespeople. Everything's great. We have the best school. You need, again, take that with a grain of salt. Financial aid officers, very helpful, often overworked, and they will be worked even further as this change comes through, in my eyes at least. But they are limited to what they can tell you. So they can't give you all the financial information, maybe how to structure debt, what's the most cost-effective way, because they can't talk about the personal financial issues that you may face. College planning professionals, there's two types. So you have the college professionals. The two major groups there are HECA and IECA. They are the people that can help you with your student prep, essays, creating your college list. And then you have people like myself on the financial planning side that are helping people understand the best way to pay. There is, in my eyes, a significant shortcoming on the financial side because it is so complex and there's not a lot of products and things that can be sold here. A lot of people don't go into this area. So just so you know that as an area. And the other thing, too, is there's a significant amount of free websites out there. You need to be careful. When you go through this process and you fill out your financial aid forms, to do it correctly, you have to put in your entire financial life, especially if you're looking at schools that use the CSS profile. What happens in many of these websites is that you're going to log in and they're going to collect your income, what assets you have, and again, you need that to generate the EFC number. That information is then resold or sold to other people. Now you're selling all your financial information, your demographic information, to a third party that's just making money off of selling your name and your email address and your address. So just be very careful. We don't do any of that on EFC Plus, but just, it is free, and it's free because there is a reason they're able to resell all that information to someone else that was buying it, similar to a Facebook. So understanding how your EFC is an important part. If that's going to affect what type of financial aid you'll get, again, that will change. You have to submit your financial aid forms each year. We highly recommend you fill out the FAFSA. Every family, no matter what your financial strength is, you should fill out the FAFSA, and that gets into understanding the debt structure as you go forward. What schools also look at is their gifting policy and the average net cost. So as I just talked about, the Harvard or the Ivy League schools, of what that average net cost is, what you're seeing is only the students who qualified for financial aid. It's not the total cost of the schools, and that gets into the business aspect. As I said also earlier, that about 35% of the students will transfer, which then will, in most cases, push back graduation. That can be a significant issue. And again, the schools only give you 1 year of information. In my eyes, you need a minimum 4 years, and in many cases, it's 5. A big misconception, too, is the EFC number. So when you fill out the FAFSA form, you only get one number. What you need to understand to create your strategy is how the number is built. And in many cases, people don't understand that. If you go to the FAFSA forecast of the government website, you fill out the FAFSA form. When you do that, you get just one number. What you have to understand, we do have a free calculator on the EFC Plus website, is that there's parents' income, parents' assets, students' income, students' assets, all have separate calculations in the EFC calculation. So, and then a big, misconception is, oh, we need to pull all the assets out of the child's name and put it in the parent's name. Well, the reason why they do that or say that is because the student's assets are weighted 20%. On the parent side, based on how you file your taxes and the age of the oldest parent, those assets are weighted 5.6%. Now, if you now know the parent side, and this is why our calculator does this, and when we do it with clients, is understanding the parent side of the equation, and you'll see this again in a few more seconds, but if now, say this number comes out to be $40,000 on the parent side without the student, and say we have $10,000 in the student's name, and that would be worth $2,000 in their EFC. So their total EFC number would be $42,000. And now we're looking at a school that is, say, a Penn State or a state school that's at $30,000 a year. It's not going to matter that we move the assets out of the student's name because the parent side of the equation is over the cost of attendance. So again, knowing how the quadrants work is absolutely critical on your financial aid position and creating the strategies. Now, one misconception also is when you have 529 money, that is a parent's asset, and all the 529 money for all of the children needs to be reported as an asset. So again, a big misconception there that you need to understand. So understanding the 4 quadrants in the free calculator, we just give you the parent side and the student side. So that will be enough information to say, okay, should I move assets? Now the problem is a lot of times parents are in that dilemma where they've applied to a state school, now they've applied also to a private school, and they have that $60,000 school or $55,000 school where they may qualify for aid, and they also have the state school. This is where you have to make a hard decision. Again, and knowing your positioning may help you on what package you think you'll get and how that's going to change over the 4 years. So again, you're going to have to make some decisions. Each case will be different, and the likelihood your child's going to go to those specific schools. As you go through the methodology, there's 2 major methodologies. One's called the federal methodology or the FAFSA form. The second is called the institutional methodology. There's some independent ones. I think in time we're going to see more and more of these. The most common institutional methodology is called the CSS profile. It's run by College Board. There's around 245 schools that use that methodology. In most cases, they're the more competitive, more elite type schools. And if you're going to go through the early decision process, so depending on who's on the line here, if you're going to do the early decision and qualifying or wanting to qualify for aid, you will have to complete that CSS profile. Now, when you do the CSS profile, because it's different at every school and how the schools manage that number, your numbers will be different at every school. So that's very, very different. Now, how the calculations differ. On the federal methodology, your home equity, your retirement accounts, and if you're a small family business owner, which means if you have less than 100 employees, it is not included in your asset number. So those are the 3 major things that are not included in your EFC calculation on the FAFSA process. What is included, though, in the years you're applying for financial aid is any deferred compensation. That would include things like contributions to your 401k and to your IRA, things like that. Now, again, the IRS system and the FAFSA system are linked together. And where does that get picked up? Through your W-2. So it is not on it doesn't affect your taxes, but it does affect your EFC. So if you're making a contribution to your 401k, that's not going to change your tax numbers or anything like that. It will raise your EFC number because that amount of income will be added back in for this calculation just for financial aid. On the institutional methodology, again, it will vary school to school. Let me take a step back. The federal methodology, your same number will be at every school. So we talked about that $40,000 or $42,000. At every school we apply to, that will be the number. When we move to the institutional methodology, it is an estimate in the system, and some schools will include a portion of your home equity. Some schools will include none of it. Some will include it based on a limited amount of numbers based on your income. So again, it can be very subjective at each of the schools. They can ask, what cars you drive. They're actually looking at trying to see your really a true ability to pay based on their criteria. So again, it will be subjective and change school to school. Here's just a perfect example. In this case, we have a student, a family that has an EFC. You can see the 39.2. So any school that's below their cost of attendance below 39.2, there's no reason to take the assets out of the child's name. So in this case, this child has, we see $4,000. As I said, it's 20%. That child has $20,000 in his or her name. So that will have an impact if they're looking at those private schools at 55 or 60, where if we're looking at the state schools, it probably has no impact. And for tax reasons, there may be reasons why we want to pull that, leave that money in. We actually may want to transfer money in here at some point in time. But again, this gets into some tax strategies that we're going to cover briefly in the future. As you also see, we have an estimated institutional methodology at 49. So again, that will vary school to school. But again, that's not a public number. When you fill out the CSS profile, they don't give you the number. We're on the federal methodology. When you fill out that form, they will give you your estimated EFC. And then when you get your what's called your student aid report, your SAR, that number will also be relevant. Okay. There is a typo here, and I apologize. It should be early decision, not easy decision. But as you go through this, your method of applications will be important. We've already passed for the senior parents the early decision. Well, there are some second methods for early decision, so that is not true. So there's some schools that have a second round of early decisions, which are typically mid-January. But if you apply early decision, in most cases, the awards are not as generous. They know that you want to come. So that's a reason maybe not to apply early decision if financial will be a big impact or big part of your decision. Early action is non-committal, where early decision is. So this is where if you don't get the money you need and you can't afford to go, you need to get out of early decision. That's the only way you can get out of it. Regular decision gives you the best opportunity to compare all the schools you're looking at side by side and seeing who's going to get you the best deal. And then the last option is if you're put on a wait list and you're not going to be a full pay, this is kind of how the schools hedge their bets. It's unlikely that it will be a good choice. So you probably, if you get waitlisted and you're not a full pay, unless you have some really special talent, it's unlikely that they're going to come back with the money that you need. Most of the times what the schools do is they use that if they've received what's called a bad yield, where the school didn't get to their average net revenue, and now they're going to go back to the schools and get the students that maybe are full pay that want to come, and that will then raise their revenue stream in the upcoming school year. So that's how that's used and why, as I said before, it's a business. Timing is everything. So the school years and tax years don't match up, and we're going to see some changes that are going to affect next year's class. And from a timing standpoint, any decisions made before 12/31. So if you have money in the child's name, again, the tax years and school years don't match up. You really need to look at that. So as an example, in the prior case we saw where the student had $20,000, if that was in mutual funds and things like that, and we needed to look at that, there may be some tax strategy we need to use, and it's called the kitty tax, and work through that and make sure we maximize the tax advantages and our financial aid position at the same time. Understanding your cash flow, absolutely critical. And also what's not talked about is, there's a lot of schools that have co-ops and internship programs. If you're a child or your family is a child that has need-based aid, and now the child goes into work, and now you're going to be reporting that income, and they make significant income, say $10,000 or $12,000 during their co-op, that's going to raise, again, in those four quadrants, that student's income is going to be raised and increase your EFC number. So if you can delay the internships and co-ops later on, that typically will help you maximize your financial aid position if that's part of your plan as you go through this process. This is the new thing that was announced in October of this year. It's called prior. It'll have a significant impact on your junior class this year, which they actually lost the whole year of preparation. Now, going forward from a financial aid standpoint and positioning standpoint, the last time to do that is their sophomore year before 12/31. So if you have a sophomore this year, you have until the end of the year to make any adjustments. So that example, we had the $20,000. How will that make? Because any decisions after 12/31 will show up on the child's taxes or will have an impact on your taxes. So that's an important part to realize. That has been now moved up a full year. And why do they call it prior is because if you look at it from the entering time frame and from when the tax year is being used, there's actually 2 years. So that's what it's currently. It's just the prior year. So this year's senior class is using 2015. Going forward, this year's junior class, they will be using 2015's taxes. Sorry. So that's where it gets into saying prior. So that's an important part. It's very confusing. Hopefully this grid will help you a little bit as you go through this process. So we talked to Ari a little bit. We talked about different things, your cost of attendance minus your EFC. You have to understand that that's going to be what you qualify for need. So, we use that, $55,000, $60,000 and the $42,000, you're going to qualify for aid, probably, $18,000 there versus, if you qualified at, look at a state school, you're not going to qualify for any need-based aid. But by just completing the FAFSA form, every child will qualify for the direct staff for loans. Bill Gates' children, if you fill out the FAFSA form, would qualify for the direct staff for loans. There's two different types of aid. You have need-based aid and merit-based aid. As a way to improve your situations, you should apply to schools where your child's going to be in that up 25% of the class. That will improve your chances for merit aid. And again, everyone thinks only about 1 to 2% of the schools will meet 100% of the need. That's an important part as you go through this process. Again, looking at every school, you talk about being need blind, but what the school meets of need and how much of it's gift aid is an important part. We do have that in our system. The schools will not typically disclose that. This is just a quick example here, is what I've been trying to explain to you. This is an important part of you understanding the process. So here you can see we're going to use the federal methodology applied to 2 different schools. Their EFC number is $25,000. In this case, you can see it's the same at both schools. At the $20,000 school, we'll still qualify because we filled out the FAFSA form for freshman year, $5,500. In the second school, we qualify for 15. The school came back with 12. Within that 12 will be the $5,500 of the direct student loans. We'll include some work study and some free money, but we also have $3,000, and that's called your financial gap. So that's an important part to understand. Again, this is part of our process that we go through, and again, expectations of what parents think and what they're going to get as need is often overestimated because of how it's marketed to them. This is just a quick, screen of our EFC Plus system. So here you can see the gift aid, and you see how it increases and why we think it's so important, because you can make a better value decision. Why the EFC number 1 gets cut in half, that's the red block, but also how the gift aid increases. Again, this is a school gifting policy. This school does meet 100% need because we don't have any financial gap, but this is because a second child has come on board. So here we can see that their EFC number is going to get cut in half, and there's the Stafford loan limits per year that you can see in the yellow. But this gives you an idea of why it's so important to look at it over 4 years and not just 1. So this is actually what the student will be paying based on historical averages. Now we move to what's, I think, the more important part, and what's not done by most families is understanding the cash flow. So it is probably the biggest reason for transfers. Financial aid is the biggest reason why students transfer. It gets into the importance of having it for 4 years, determine how to use your assets. So do I use a 529 plan, a grandparent's 529 plan? How do we structure the debt? All those things are part of this planning part, because again, in most cases, you're going to be spending between $120,000 to $250,000. Again, getting your information from the colleges is typically not enough as you go through this process. As I said earlier, the life insurance annuity products, you need to be really careful with that. It really affects your cash flow. It will improve your financial aid position a little bit. Again, it depends on your personal situation, but what becomes a problem is that now you've put it in this investment and improved your financial aid positioning, but now you have to pay the bill. Now to pay the bill, you're going to have to borrow that money typically at a much higher rate than what was guaranteed to you within those products. So that's where it becomes a negative event for many parents. This gives you just another example. So we saw what the first chart we saw was what you will be paying over the 4 years. But now you have to understand, okay, how have I saved? So in this case, this family has about $3,000 saved. They can afford $10,000 per year. And now here's what it's going to cost us to get this child through this school. As you can see how the numbers will flow out, the red is what they'll need to come up with over the 4 years. In addition, so they can either raise their contributions, that's the blue section, so increasing their amount, or the second option is, okay, we're going to have to borrow this money. Now, how do we borrow this the best way? And this is the part that is new for many families. This is what we're trying to do to increase the financial literacy across the student body and the parents, so that their child doesn't graduate with this enormous financial debt at age 25. So that kind of concludes the part of the financial positioning standpoint. We're going to quickly go through the different financing options as you go through this. You have what's the direct or Stafford loan. It is a progressive amount. We saw that how that's going to work. And what I mean by progressive is freshman year it's $5,500, sophomore year it's $6,500, junior and senior year it's $7,500. Now that can be split depending on your financial aid positioning with a subsidized or unsubsidized. Subsidized means the government will pay the interest while the student is in school, and that would include graduate school or law school. With an unsubsidized, interest is being charged that loan after the second disbursement. So again, understanding how that's going to work is critical. That is a student loan. It is their legal responsibility, and I highly recommend, again, everyone that fills out the FAFSA form will get that. I highly recommend the student take those because they have better student loan repayment and loan forgiveness options, even from the beginning, unless you think you're going to pay for the whole thing. This is where the cash flow, if now you're going to run out of money, say junior or senior year, and you didn't take it at the beginning, it doesn't accumulate. It is a per year and a lifetime limit. So each year it's capped at those amounts, and it doesn't build on each other where you can go in your junior year and take the prior years you didn't take. You have to take them as you go through this. The Direct Parent Plus loan, you need to have decent credit. It's not horrible. But again, the first two are legally are federal programs. There's some advantages to those in the sense that there's some disability and death benefits if, God forbid, something happens to either the parent or the student, depending on who the owner of the loan is. So it does have some advantages. The problem is with the Parent Plus loan, when you add in the fees, the cost of borrowing that money is close to 10% right now. So it is a fairly expensive loan in today's dollars. The next part, and that legally is the parent's legal responsibility. Even though you've taken it on behalf of the child, it is their legal responsibility. Now we start moving into, again, understand that legal responsibility. The Parent Plus or the private loans are loans that are owned by the student, but there's going to be a cosigner. That cosigner is typically the parent. And now if that child should default on that loans, the bank's going to be coming to you. It will also hurt your credit as you go through the process. So again, understanding the differences is really, really important. And then you have the alternative loans. This could be something like, taking money out of your 401k as a loan, taking money out of a home equity. Again, understand your cost of money and the benefits or disadvantages of each of those. So, for example, if I take money out of a 401k, that may be my cheapest money. It may have the least amount of impact on my financial aid positioning, but now maybe the business you're working at has a layoff and you get laid off. Well, that's going to affect because you have 60 days to repay that. Or now you want to change jobs and the same thing will happen. You have 60 days to pay back that withdrawal that's in your 401k. So again, these are all important parts you need to realize in making those decisions. To move to the tax credits, again, this is often overlooked at times. We just had a client where we are trying to manage their 401k contributions to get to the adjusted gross income line to qualify for the opportunity credit. These are different tools. Again, it's worth $2,500 as a tax credit, so that's a dollar for dollar. You could call it a $2,500 tax credit, and it is per student. So if you have multiple children in school, that could be worth $5,000 of money if it's done correctly. There's some interest or college loan interest deductions. If you are self-employed or if you're in that upper income level, there's some really great gifting strategies you can use. There's some self-employment things you can do that can lower your tax bracket and transfer that onto the student's level, which can be very beneficial. And as we saw in that one example where the student had $20,000 of assets, that may have been in cash. If it was in mutual funds, you can only liquidate, if the student's going to have capital gains, there's what's called the kiddie tax. If the child is a dependent up to age 24 and a college student and they're not independent, then the kiddie tax will kick in. And that means that anything of unearned income exceeding $2,100 will be taxed at the parent's rate. So this gets into where, we had that $20,000 in the student's name, but we didn't prepare enough and we cashed it all out. We could have a capital gains at a tax at a 23% on top of the impact it's going to have on your EFC calculation in those outer years. So again, doing some advanced planning is critical. Next part of the program, we're looking at comparing value. So you have to look beyond the sticker price. So everyone just looks at the your sticker price. Many of the private institutions, when you factor in graduation rates and retention rates, it could actually be a better value. So these are important parts to work with your clients or work as a family. Just don't close those down because many of the private institutions are trying to attract the better students, and they will graduate. When you look at the net cost, and now say that student's there at the state school that was cheaper and is there an extra year and now has lost a year of possible income because they were not working, where the other student went to the private school and graduated on time. In many cases, the private institution could have been cheaper. Again, every case will be different based on your award packages and what your net cost is going to be and the jobs they get. But again, in some cases, you really have to look through that and understand the value that the schools are all delivering. Understanding what the career education requirements are, absolutely critical. The sooner you can do that, the better. And again, the schools will only give you 1 year of views, and really our process by giving you the graduation debt, and as that will evolve, when we have a second tool coming available, hopefully early next year, in the sense that once, our product right now is showing you what you're going to do and does the award analysis. But once you now, change majors and change your graduation dates and your cash flow changes, your EFC num changes, having a view of what graduation debt and how it's structured and how you're going to repay that is absolutely critical. Envisioning the child's life at 25 is all part of this. These are just some of the other things you need to be looking at: graduation rates, admission rate, needs. Again, this is part of our EFC Plus system, putting it all in one place for you. And then showing the outcome. So what's unique about our system also is you put in the award letters. It's one of the few systems, I don't think there's another system that does this, where you actually key in the award letters, and then based on your personal situation and cash flows, we regenerate what your outcome will look like by school and sort it by the cheapest school. Now, in this case, you can see here's a private institution, two private institutions. They're almost the same cost as the public institution or the state school. Again, looking at your outcomes, you have to see what you're trying to do there. So just a quick thing on some other tools that are out there. All the schools have a net price calculator on their websites. The quality of that will vary greatly school to school. A lot of the schools don't maintain their net price calculators, so that becomes a disadvantage for many parents. The government does have a FAFSA forecaster. There are some inconsistencies, or it doesn't really give you a good forecast if you have some deferred compensation, which is not included. So your numbers can vary greatly. There are, again, the private websites and private companies out there. You need to be careful of the free. And then on our website, I can tell you that we don't sell any of the information. There is a free EFC calculator. It will do both methodologies and break it up into the different quadrants, which I think is important for you. And then looking at the things here, as you start trying to create your plan, as you go through this process, having a 4-year plan. I think that's what makes our tool or our process or method much different. We're really trying to help the parents and the student envision the outcome. Why are we going to school? It's just not an experience anymore. It's too expensive to be just an experience. You need to look past that. Understanding the cash flow is what's new. Again, this is why we're seeing college debt go and grow. We don't look at that, and there is no, unlike any other things that we finance. If we're going to finance a car or a house or something like that, there's a bank or someone that's approving us in this case, in many of the cases, because of the bankruptcy rules. And there is no asset except for your personal brain as you get your college degree that can be reclaimed. So that's why the bankruptcy rules are like that. Understanding the complications of the debt structure, as I said, another thing we've just recommended is that you take that student debt at the very beginning, because if you compare what you're going to pay in the undergraduate debt versus if you're going to be going to grad school, or the student's going to be going to grad school, you're at 10% at a grad plus loan, versus on the undergrad debt, taking the beginning, you're at 4.29%. So again, looking at that difference, it may be beneficial to take the debt on early and reserve resources to defer the higher interest debt, which is kind of critical. Knowing, again, with our process, by doing the 4 years, if you have multiple children, we reflect that EFC change, which is absolutely critical, because you may qualify for more aid based on the schools you're using or comparing. And then looking at the best value comparison. So, we saw that other screen just prior to this, that we do all the math for you based on your actual words. So at the beginning, when you're creating lists, we're using historical averages. But what's unique about us is that you're putting actually what you've received. It's going to regenerate the numbers, what you received, and also changing that EFC number if maybe the first year or two you don't qualify. Or the inverse is maybe you have a second child that's coming in and using the tool, and now that oldest child is going to graduate. The first 1 or 2 years may look very attractive for you, but now that oldest child is going to graduate, and now your EFC number is going to go back up, and you may be paying full price. So That's also one of the reasons why we do the 4 years. You can see the full value in one place. So there's just some, our website, we're blogging each week. I would tell you, if you haven't, most of you probably that are on the webinar have signed up for the newsletter. We do send that out once a month. We do have in January coming up some complete your FAFSA nights, and then people that are on the tool, there'll be Ask the Expert nights. So we have those things coming up for parents. And if there are any questions, you can type them in. I'd be happy to answer those. I have one question on the matrix. So I just want to take a quick view back to the matrix there. Can you re-explain financial reach is the question. I apologize. When I do this, it gets very blurry for you, so I apologize. I may have gone past it. Oh, there it is. Okay, so I apologize for the blurriness there as you went through this. Everyone's familiar with that horizontal line. So, the child that has, the 3.0 and the, average SAT scores is not going to get into the Ivy League schools unless they have this other special talent. Is what we're trying to show here is minimize the amount of schools people waste their money. We're doing some calculations on the amount of waste, and we're figuring out that about $1.5 billion are wasted on each year between transfers and schools that are applied to that shouldn't have been applied to. So if we go further away from that 16,000, that's the average package at the school, and this child does get in, even if they do get in, the package will probably be close to the 16 where they need the 32. And if that's the situation, even if they do get in, it's not financially smart to be going to that school. And this then gets into, maybe they do go, and you talk to admissions people, parents don't care, and they're still going to make the decision because the child needs to go to that school. This is where we see parent debt going through the roof. We're just starting to see some articles on information where parents are defaulting on their Parent Plus loans, and they will garnish their Social Security. So the financial consequences are pretty severe. And again, I'm not saying you shouldn't apply to these schools if you have them on your list, but you also should have a measured expectation. As we get further onto the right-hand side, you have less and less of a chance to get in and less a chance of getting what you need to go. Again, unless you have some special skill set that should raise you higher on that grid. So where that blue dot is, will have you higher on the grid. So hopefully that helps a little bit. Any other questions? That's all the questions that I have today. So one, I just want to thank everyone for attending. And if you have any questions or need or looking at the EFC Plus tool, I do appreciate you taking a look at that. There is we have a whole video library. We're doing different webinars. The blog articles are really helpful. We're trying to keep everyone up to date and just be a great resource for parents, college planners, and college guidance officers as you go through this very complicated financial decision and life-changing event as far as looking their quality of life based on the education they can attain at graduation. So just want to thank everyone for signing on today, and have a great day and have a great holiday season. Thanks. Have a good day.